Thank you for joining us for Vision Capital's first video format investment update. We hope you find this new format valuable. First, let's review the last year for both markets and the economy. 2023 was a year of recovery for markets, with a strong bounce back after a difficult 2022. The S&P 500 gained 26% and ended only 3% below its all-time high. Bonds gained 5.5% after back-to-back years of losses. One topic we've been focused on recently is market concentration, given very strong performance in a handful of large tech companies. This chart shows how much the largest 10 companies make up of the S&P 500. We're reaching levels last seen at the peak of the dot-com bubble. This doesn't mean we're near tech bubble 2.0, but we're always wary of portfolios becoming less diversified, which can lead to too much risk. The equal-weighted S&P 500 was only up about half as much in 2023. Let's turn to the economy. The million-dollar question is how and why the U.S. has avoided a recession despite the Fed raising interest rates by over 5%. We, and almost all economists, expected the increase in interest rates to slow the economy more significantly. It really has come down to fiscal stimulus and balance sheets. Both consumers and companies have been largely insensitive to higher rates. Both spent years locking in low-rate, long-term loans. Both also received lots of money from stimulus packages since the pandemic. It's taking time to work through the excess savings and liquidity built up, much longer than first expected. But eventually, as these wind down, both consumers and companies will become more sensitive to interest rates. This chart shows that companies have slowed hiring over the last year, back to more normal levels. Job openings have also fallen. But the labor market remains tight, and we have not lost any jobs. Here we see how inflation has eased and appears on its way back to more normal rates. It turned out that much of the inflation in 2021 and 2022 was in fact due to temporary supply shocks from the pandemic and the war in Ukraine. Wages and services inflation remain elevated, but this has not led to another round of sharp price increases. We can see here that stocks are very much priced for a soft landing outcome where inflation continues to ease and the economy continues to grow. The S&P 500 is now trading at 19 times earnings, above its 10-year average of about 17 times. This is despite higher interest rates, which historically result in lower stock valuations. Markets are quite optimistic that companies will get back to strong growth this year. Elevated valuations are being driven by the concentration of the largest companies. The Magnificent Seven are valued at 31 times earnings on average, while the other 493 companies are valued at only 14 times earnings. We also see an opportunity to own more small-cap stocks. This chart shows that the small-cap index is the cheapest it has been relative to the large-cap index in at least 20 years. In fact, you can see prior to the pandemic, it was more typical for small caps to trade at a premium due to their higher growth prospects. That has completely flipped since the pandemic. We believe this can get back to more normal in a soft landing scenario. Now let's turn to our outlook. We still see two paths for the economy. Either a soft landing, which appears much more likely, especially if the Fed does lower interest rates in the months ahead, or a recession. This is a lower probability, but still remains a risk. Stocks are very much priced for the soft landing, so we need to be careful in case it does not play out that way. We are increasing holdings in small company stocks given the attractiveness I just discussed. We still hold cash, mostly in treasury bills. The returns are now attractive and the liquidity will be valuable if markets remain volatile as we move through 2024. Thank you for taking the time to watch our update, and we look forward to seeing you again next quarter.